basically what's happened to an ETF that we've been trading that is basically called Jnug, Jnug, which is the Direction Shares Trust Dollar Junior Gold Miners, a triple X volatility here. It's broken basically a major level of support that we're looking at below $10, below $10 a share. And I want to go back here a little bit and look at what's happened here. Basically, since the high of 43 that was made in March. This past March. This is the recent high here before this correction unfolded, and this top came in from a low that was made at about 1286 back in December of 2013, and so it pretty obvious here that the price has come down and not only broken these levels of support or the June levels of support, but we are definitely in extremely oversold territory. And the what I want to do is just examine the technical aspect of the market, and then we're going to take a look at the reasons why we're here and how we can best take a look at this as a trading opportunity presenting itself as, I believe, in the history of this market. And this is a major, I think, buying opportunity. So if we take a look at the trend line here from the low that was made in April 24 to the low that was made on May 28, we see that the markets come down right into this line of support, and pretty much it's trading right around this level. So what we are looking at or identifying here is that there is some kind of a descending wedge that the market is building. These are Fibonacci fans that you see. We are analyzing it from the highs of 43.14 that was made in April of this year to the recent low. Let me adjust the fans here to the recent low, and let's see what we can look at. But let me adjust this as well. And what we're going to do is just take a look at from what's happened today where we are. But you can, in doing the trend lines, the basic trend lines, you take the high that was made from the previous move to the recent high, and that gives us basically the trend channel that you can see here obviously has been into the downside, and that we have come down into this uptrend channel level of long-term support, and that's what we're trading on right now. If we do some more trend lines from the high that we saw in July recently, we begin to see that what we have is a sharp descending wedge, number one. And that indicate, and we're at the bottom of the wedge, and so either the wedge is going to break through this and establish new lows, historic lows, or this is telling us that this is the vertex point where the two lines meet, and that usually is a termination point of the correction. And so this is pointing to, in the neighborhood of 909, as the ultimate pivot point completion. But so far, we're right into this level of support. So we have a sharp descending wedge, which is a bullish sign. Once the market breaks above the upper end of the channel, it's extremely bullish, and the target you're looking at is the upper end of the resistance trend line of the channel. If we draw a horizontal channel, basically you can see that the price of about 43 seems to be the upper end of this long-term channel that we're in. And if we do a channel now, pretty much using this lows here, then you can see that where we are is at the bottom range of this channel in here. And even though the market has broken the lows of December, according to some technical analysts, it pretty much negates the up move that's supposed to be coming. But if you're a contrarian trader and you look at what's happened every time we've come here, back in June, back in May, we had the same sentiment where everybody was calling, for this thing to bottom or to just collapse. And in fact, we rallied from here. And, we have pretty much the same sentiment. And with all credit due, this range right here has been accomplished in just the past 3 days. So it's been a breakdown from this little wedge that we have here into what I think is an extremely oversold condition. But as a contrarian, you would be looking for confirmation for the market to hold here and to ideally come up above 1379. And let's take a look at, in using the fans, the Fibonacci fans from the high to the recent low here today, and see what it tells us here. And what it tells us here, obviously, is it pretty much confirms the upper end trend channel that we drew before, and it gives us the shorter term resistance levels that the market has to challenge. And so what this is saying here now is, once we get this completion down here, or this energy completion, this resolution, then the resistance level that we're looking at is into that 2084. 960 seems to be potentially the pocket, if you were to try to pick a bottom, where at a maximum worst case scenario, it looks like the possibility is there that this could come down here. But if you measure the percentage move from 43 made just in March to a low of under 10, kind of gives you the idea of the volatility of this ETF, and why I particularly like it, because if you're a trader, what you want to look at is volatility, liquidity and volatility. And the gold market has provided for us the volatility to be able to take this ETF and go from the 1266 area back in December to a high of 43, back down to 13, up into the 36 again, and now we're dealing with under $10, which I find it completely overdone on the downside. You're dealing with a fluctuation of anywhere from 300 to 500% within months on the instrument. I'll tell you, I've been around for a while, and there are very few instruments that were available before, as they are now, by trading these ETFs that are, 3 times the volatility. So how do you take advantage of this, or where could we go from here? Well, initially, what this indicates is that we are at major levels of trend line support in this downtrend channel that was established back in March. And as you can see, every time the market reaches these prices, it has a reaction. Based on where and how fast they took this market down, it increases, I think, more the probability that this market is overdone. Let me take a look at the RSI, the Relative Strength Index, and see what it tells us in terms of the oversold condition in the market. And you can see here where it is. It's it's under 30. It's at the lowest level it's been so far. Okay, this year at least, and this indicator is basically the relative strength index that measures the oversold or overbought condition in the market, and with a high degree of accuracy. We use this as one of the leading indicators and components in making up the VC price momentum indicator. But you can see right here that the market is extremely overdone here. The worst it's been overdone this year. The price is here. So the likelihood is that this level is overdone here, and we could see more than likely the path of least resistance to the upside. And where can it go? If this is the low, you define the resistance into that 2116, 2514, and the upper end of the band is 29. If it breaks 29, then you're going to establish another band, another uptrend, or another channel or another fractal in price. But so far, the upper end of this fractal is in the 30s. The upper end of the price is in the 43s. And in using just a basic Elliott wave analysis, this is the first leg. Actually, this is the first leg back in December. To the high of 43 is the first. The second completed back in May. The third was the rally up to July. And you have potentially the completion or a 5 wave. You can see you can count the waves 1, 2, 3, 4, 5 on the first leg. 1, 2, 3, 4, 5. The second one. 1, 2, 3, 4, 5. The third. And this is the fourth wave correction. So I don't think that, according to this, it indicates that the upside is over. Number one, if in fact this could be indicating the possibility that this could be the fifth wave building up. But I am not an Elliott wave expert in that sense, although we use the wave counts for us to identify the different levels of resistance and support. Let's just take a look at the Fibonacci retracement and, in fact, see if this low holds, this level holds, where the retracements projections could be from a percentage point of view. And here, once again, we confirm that the 1733 level is a 23.6% retracement. Breaking above this resistance line that we drew on the fan lines, then the next level matches the fan line at 2223. which is a 38.24% retracement. And then the upper end is the 50% retracement that matches the 26.19. Beyond that, you're looking at 61.8, which is 30, and the 78.6%, which indicates still 35. And as you can see, the markets have the potential to reach the 78% retracement on the upside or the downside, like it's done here, and go beyond that, in fact, of the previous move. The lower it goes from here, it seems to indicate, according to the algorithms that we use, that it's becoming into an extremely oversold condition, and it basically is initiating that shorts should have extreme caution down here. Should be very, very cautious. And so what we want to see is the market come back from these levels, accomplish the goal, if it has to complete that 9, test that 9 level of support. It's not that far away from there. And upon reversal from there, it would be a trigger. And confirmation, obviously, would be for the market to close about 1255. That would be additional confirmation, and that would pretty much confirm, I think, breaking above this descending wedge resistance, which is the initial one that identifies the market is building a bullish pattern. A descending wedge is a bullish pattern by breaking above the resistance level. I continue to say that even if it comes down into this level in the 9, it's more oversold, becomes extremely oversold, and the likelihood is basically the reaction could be very, very sharp to the opposite direction, which I believe over the long term, the dynamics of what is going on fundamentally fall into that same thesis, that what's happened here with the gold market is, I think, beyond anything that I have seen in the past 30 years, and truly doesn't seem to make any sense at all when the unemployment number came out and was announced that it's the lowest in 30 years. So they've been able to basically bring the price of gold and silver to these levels artificially in the paper market. This is the futures markets, and they have been able to so far actually sell about 10 years, more than 10 years worth of production in the futures markets, and be allowed to do that. And in doing so, literally driving the mining industry completely out of business to the point of extinction. We're going to see major cutbacks in production. We are hearing that there are companies that are highly leveraged or margined or in debt, are basically closing the doors. And this is primarily precipitating what I believe is a self-fulfilling prophecy of a shortage in the future. The fundamentals based on just the supply and demand, which I have written extensively, showing that demand is above production by, I think, 200 or 300 million ounces in silver, and the price making these new lows into that 1664, I think is actually telling us that something else is really going on. And we have to listen to this information, because what this is happening, what's happening here does not make sense. if you integrate silver and gold as a currency, which is what I have observed. Basically, it's taken place or has been taking place, particularly over the past 6-7 months. There is a closer relationship of trading silver and gold against the US dollar. And a day like today, announcing the unemployment numbers to be the lowest in 30 years, needless to say, gave the dollar some support and a reason for the powers to be basically to come in and wash out this market, which is what they're doing. They're washing out anybody that is margined, that is highly financed, that is on leverage, you with me, so that they will give up their positions, liquidate, and in doing so, turn over whatever, if they have any physical, on the hands of the central bankers. This is absolutely the way that they shake out any weak buyers or players in the market. But the fact that the price is here, to me, it's an incredible opportunity, because this will adjust as long as I've been around, and it's been a number, it's more than 30 years. I've never seen anything like this, number one, but when things do get to an extreme, because there are economic relationships between gold and silver, between gold and crude oil, between gold and, the 10-year note and the 30-year bond, there is an intermarket relationship. There is a real matrix of economics. There is a real relationship. And when you put the price of gold and silver in the basket of currencies, what we're finding in our analysis is that it is the cheapest currency in the world. It's the most undervalued, cheapest currency in the world. And you have to ask, why have they done that? And it's done in the same fashion that they have manipulated interest rates, the LIBOR rates, mortgage rates, and obviously the price of the dollar, the price of stocks. I don't believe that this is the real picture, what they're telling us. And I question the fact, because it's during an election time, and the need right now is essentially to get everybody scared to death out of the metals markets. And I'm hearing people making statements that you're looking at $700 gold. These are, the same people that were saying when gold was at 1,900 it was going to 3,000. These are the Goldman Sachs of the world. And you have to really question their motives. When you put things in perspective and you analyze the dollar, there is no justification for the dollar to be where it is right now, except as a flight to quality. Not because it has better fundamentals or better economics than the rest of the world. Maybe right now, I would say it's the dirtiest shirt and the dirty laundry, there's no other currency to go to when you really think about it, as the rest of the other currencies begin to implode. You look at Japan, look at the world debt to GDP is running at record levels. And if you include the derivative markets, that now you're talking quadrillions. It's a pretty risky situation if interest rates begin to move up. And so what are they telling us? That the economy is the best in 30 years, and so that, are they going to push interest rates up sooner? Are they going to be motivated to do that sooner? I don't think so. For every percentage point in interest rates based on the debt to equity ratio, you're looking at about $200 billion in interest payments, in increase. And so I don't think that the feds or the government has a real easy way out of this tremendous quantitative easing or increasing the balance sheets the way that they have, to the point where when the rest of the world is falling apart, the Eurozone is falling apart, Draghi they don't know what to do. And I think for the first time, one of my subscribers mentioned the fact that he had fear in his eyes. And, this is one of the leaders, supposedly, of the Western world. They're pushing, I believe, these levels to the limits, obviously. So far they've been able to get the paper market price to these levels. But I believe that what we'll see come next week is, and I think you might be looking at the transfer of the actual ownership of the metal in the same way that it happened before Shearson Lehman collapsed and Smith and Barney collapsed, before the 2008 crash, you might say, that came in, that brought the price of silver down to about $8 or $7, just before J.P. Morgan took over the books of the silver book and the metals books of both companies. And after that, of course, it went to almost $50 an ounce. And so it just seems that somehow this manipulation or this price pressure that's being put on here, it's not really justified by any real market above it, except the paper pressure that is well financed, and I think we know who is behind this. Diamond, is on the board of directors of the Fed, that dictate policy, obviously, for interest rates and so on. So it's a quiet, it's a nice, comfortable club that seems to be, or at least they think that they can, manipulate the world economy to this point. But what really I'm concerned with, I think more than anything else, is the disparity that this has put the European economy to the U.S. economy. And to think that the U.S. economy is the only economy in the world who can raise interest rates while the rest of the world is imploding, who can, have the best economy in 30 years while the rest of the world is imploding, I think is a fantasy. There is no country that is an island in itself at this point, especially when we are so globalized in the economy. And so I find this move down here, for those that are long, I sympathize with the pain. I understand. I myself am in the conviction that this will adjust. And I think it's just a matter, once again, of time and being patient, not over-margining, not take, margin on your positions, not leverage, but to strategically build a position that you can look back, and I don't think it's going to take much time for this to resolve itself. I think that what our work is saying, we have maybe a couple of years, 2 or 3 years, before we're looking at this as really what they are, which I think is one of the greatest buying opportunities of our lifetime. I want to continue to take a look at this situation very closely, and see what the market tells us here in the next week or so. And I will be doing some analysis over the weekend, which I will publish, that will give us an indication of what the market is going to do come next week. So until then, I hope this was able to give you some idea where we are and where we're going, and I look forward to talking to you soon.